IWM and VTWO are two ETFs that give investors exposure to small-cap U.S. stocks, but they differ in structure, cost, and how they track their target indexes. If you're looking to diversify your portfolio by adding small-cap equities, companies with smaller market capitalizations that have high growth potential, understanding the key distinctions between these two funds is essential. IWM is the iShares Russell 2000 ETF, and it's one of the most well-known small-cap ETFs on the market. It tracks the Russell 2000 index, which includes approximately 2,000 of the smallest companies in the broader Russell 3000 index. These companies span a wide range of industries, including healthcare, financials, industrials, and technology. IWM is widely used by both individual investors and institutional traders due to its liquidity and long history. Its expense ratio is 0.19%, which is relatively low, though not the cheapest among small-cap ETFs. IWM offers a straightforward way to capture the performance of the broader small-cap market with one fund. VTWO, on the other hand, is the Vanguard Russell 2000 ETF. Like IWM, it also tracks the Russell 2000 index, so its portfolio is nearly identical in terms of holdings and sector exposure. However, it has a major advantage when it comes to cost. VTWO's expense ratio is only 0.1%, making it a more budget-friendly option for long-term investors. Vanguard is also known for its investor-friendly structure and long-term focus, which appeals to buy-and-hold investors. While VTWO may have lower trading volume than IWM, it still provides solid liquidity for most retail investors. Now let's break down the main differences. First is cost. VTWO has a lower expense ratio, which means less of your investment gets eaten up by fees each year. Over time, that small difference in cost can add up, especially in a long-term portfolio. If minimizing costs is important to you, VTWO has the edge. Next is liquidity and trading. IWM is one of the most actively traded ETFs on the market. That makes it a favorite for short-term traders and institutional investors who need tight bid-ask spreads and fast execution. If you plan to trade frequently or in large volumes, IWM is likely the better choice. VTWO is still reasonably liquid, but not at the same level as IWM. For long-term investors, that difference usually doesn't matter much. Another factor is brand and ecosystem. Investors already using Vanguard for other funds may prefer to stick with VTWO for simplicity and convenience. Likewise, those who use iShares or BlackRock platforms might favor IWM. Both are reputable providers, so it really comes down to personal preference. As for performance, since both track the same Russell 2000 index, their returns are nearly identical over time. Any short-term variations are usually due to minor differences in fund structure or tracking error, not underlying strategy. So which one is the better choice? If you're a long-term investor looking for a low-cost, efficient way to gain exposure to small-cap U.S. stocks, VTWO is likely the better option due to its lower expense ratio. But if you need higher liquidity for frequent trading or institutional-sized moves, IWM might be the more suitable pick. Both funds offer access to the same index, so you're getting similar diversification either way. The decision really comes down to how you invest, whether you prioritize cost savings or trading flexibility.